Pretend for a moment that you're interested in a whole life insurance policy for the cash value benefit. You're doing research, you're speaking with those who you really trust when it comes to finance. You meet with our company, let's pretend you meet with me, and you ask, Steve, why do people do this? Like, why do they take out whole life insurance policies for the cash value benefit? And explain it to me in 30 seconds. Here'd be my response. People take out whole life insurance for the cash value because they view it as a safe area they can position money, that they could use like a personal line of credit, and it has a really nice tax benefit. In short, the cash value is a safe, liquid, and tax-free area you can position money. That's why wealthy people and corporations put tons of cash into these policies. So it sounds great, but how do they use it? So what we're going to focus on today is how people use the cash value in their whole life insurance policy, which will really focus on that personal line of credit example. So the second main benefit of a whole life insurance policy. So a lot of people we work with will do this, and we'll see it a lot with real estate investors. We'll see it with business owners too, but it is most popular with real estate investors. Once one understands how they can use the cash value, it's very common for them to put a lot of money into the product and then frequently use it for opportunities. So we're going to demonstrate that today. So again, we're using it, the cash value specifically, as a line of credit. And the first thing that is required here is moving money into a policy. There's two approaches here. One, someone may cash flow a policy, meaning they say, here's how much I want to fund the policy with per year for the next 10 years or until age 65. Where the second common approach we see is someone has a lump sum of money. I've got $1 million in cash and I want to move that into a policy over the next 4 to 5 years or something like that. Now, when it comes to the policy, here's the most important piece. Maximizing the cash value first and foremost. Before we look to use the policy, we need to make sure that the cash value is maximized, because if it is not, this is where buyer's remorse pops up. So we can call this the policy setup or how we design a policy, and we're going to go through two examples here. Number one is a basic policy setup. Pretend you're paying $10,000 per year. A basic policy setup would be a basic whole life insurance policy, which would give you, in the first year, a cash value of anywhere from 0 to 30% of what you paid in. So at $10,000 per year, you would have anywhere from 0 to $3,000. If it was $100,000 per year, guess what you would have? Anywhere from 0 to $30,000 in the first year. And on average, this will take 10 to 15 years to break even. The break-even point is when you get all of your money back, when you see the cash value equal to your total payments. And then from that point forward, you'll see more in cash value than what you paid in. But this is a basic policy setup. And then we've got a high cash value policy setup. Could be the exact same policy with the exact same company, just set up differently, where the first year cash value we'll see between 80 and 90% on average, and a break-even point between 3 to 5 years. So the first example would be an example we would not recommend, and the second example is what we would recommend. Maximize the cash value first, and then when it comes to using the policy, well, it's a whole lot easier because you've got more money to work with. So let's pretend you've got a policy, you funded it for a couple years, you've got a big bucket of cash value here, we'll call it $500,000. So your policy, we'll pretend you have a death benefit of $1 million, cash value of $500,000. We're going to keep the numbers very simple today. We'll assume you've got a net growth rate of 5% and a policy loan rate also of 5%. And 5% of $500,000 is $25,000. We'll pretend in 4 years that'll be worth $600,000. That's not accurate math there because you do compound, so the interest on a whole life insurance policy is compound interest. This is just 5% simple. 25 times 4 years gives you 600. Again, purpose of that is just to keep things really, really simple because we're just going to stick to the whiteboard today. So let's assume you've got a real estate opportunity that comes around that will produce you 10%. However, it requires capital of $300,000. You have $500,000 in cash value, so you decide to borrow against your whole life insurance policy to take advantage of this opportunity. How does it work? Well, when you take that policy loan, the 5% or whatever the loan interest rate, that is money that goes to the insurance company. So 5% of $300,000 is $15,000. That will always go to the insurance company. So they do make money off of loans. Now, if you borrowed $300,000, you originally had $500,000. So what do you have left over as far as what you can still borrow against your policy? You've got remaining equity of another $200,000. Here's the thing though. You continue to earn that 5% on the full $500,000 that was in cash value before you took a loan. So you've got access only to another $200,000, but again, you're still earning 5% on the full $500,000. So again, we're keeping the math simple here. We're assuming a policy growth rate of 5% and a loan rate of 5%. And when we do that, in this example, the numbers look good because you're receiving $25,000 in earnings from the insurance company and paying them $15,000, so you're positive 10 grand. If you've started a policy recently and you're in the early years, that growth rate might be 2, 3, or 4%. Depends how long you've had it and how you funded it initially. So the numbers may not be in your favor. This is where it's always important to look at the numbers, and we do have a loan workbook which tells us exactly what the numbers will be, and we look at this with people that we're working with because it's important to do so to make sure we have transparency as far as, am I earning more money than what I'm paying, or is it the opposite? But I just wanted to mention that because it is important. But again, in this example, getting back to it, you're paying $15,000 and you're receiving $25,000. So how are we going to attack the loan? Well, in the first year, we're going to pay interest only, and then beginning the second year, we'll continue to pay the interest and also apply $100,000 per year toward the loan. Why I picked the $100K is because when we begin to attack it, we're going to pay it off in 3 years. 1, 2, 3, the loan balance is $300,000. Again, very, very simple numbers here. That's the purpose of this exercise. So after the first year here, or if we back up, you had what in cash value? Down here, $500,000 at 5% is $25,000 of earnings that you're receiving from the insurance company. When that $25,000 is added, that brings your cash value up to $525,000. Your policy loan, $300,000. Cash value equity, $225,000. Why is it $225,000? Well, gross cash value is $525,000 minus the loan. That's how much you can still borrow with your remaining equity. Now, your death benefit is $700,000. The reason why is because without a loan, it was worth $1 million. Deduct the outstanding loan, you're left over with $700,000. So anytime you have a loan outstanding on a life insurance policy, you will see a dollar for dollar reduction on your death benefit. Next year, cash value has now grown to $550,000. The reason why is because we earned another $25,000. I know it's simple interest here. Normally it would compound, but again, we're keeping things simple. So now your cash value has increased to $550,000. You made a loan payment of $100,000. This brings your policy loan balance down to $200,000. What's 5% of $200K? Because that's the interest you're paying to the insurance company now. $10,000. What are you earning? Or what's the insurance company paying you in total dividends and interest? Still $25,000. What's your cash value equity? It's whatever your total cash value is that's earning dividends and interest minus your outstanding loan, which gives you $350,000 in this example. The death benefit is now $800,000. It went up $100,000 because you applied $100,000 toward the loan principal. See what's happening as you pay that loan down? Your cash value equity goes up along with your death benefit. The next year, you do the same thing. Well, first, your cash value receives another $25,000 of earnings or interest. You pay another $100,000 toward the loan. That's a principal payment, which brings the balance down to $100,000. What's 5%, which is the policy loan rate? What's 5% of $100,000? That'd be $5,000. Your gross cash value, $575, minus the outstanding loan of $100 is what? $475. So that's the equity you now have access to. So if an opportunity came up right here, you said, hey, I want to borrow another $300K, could I? The answer would be yes, you could. Whatever is available in equity, remaining cash value, you have access to in a loan. Your death benefit has also come up to $900,000 in this example. Then the last year, we make the last loan payment, the last $100,000, the loan's paid off. Interest is zero because there's no loan outstanding. Your cash value with another $25,000 added is worth $600,000. Cash value equity matches the total cash value because there's no loan outstanding and your death benefit is restored. Again, I know that the math is not 100% accurate here because the interest would normally compound and the policy growth rate might be around 4% instead of 5%. But I think you see what I'm going for here as far as illustrating how this works. Now, my favorite thing to do in a case like this is to look at how much did I earn in total interest and how much did I pay in total interest. And again, if you're very technical, we've got a loan workbook that goes through this. We've got a lot of videos that demonstrate this as well. But what we would do is tally up all the years of earnings. So here, total earnings, let's call it here, it's $100,000, 4 years at $25K. And then what we would do is tally up the total interest paid. So you've got 15 plus 10 is 25, plus 5 is 30. There we go. So we can see the total interest we paid. And if you've seen some of our other videos where we really break it down in Excel or look at direct policy loans, we can make the numbers the opposite, or not quite the opposite, but we can have a case where we're paying more to the insurance company in loan interest than what we are receiving from them in total dividends and interest. So having awareness of what the numbers look like is very, very important. And that's why we run the numbers with everyone we work with, often before starting a policy and especially after. If you have a question and you're asking, hey, can I see what this loan would look like if I'm going to pay it back over the next 5 to 10 years? How much am I going to pay the insurance company in interest? And really what I want to know is the total amount I'm going to receive in dividends and interest going to exceed what I pay them in loan interest? Am I getting more than what I'm paying, or is it the opposite? And that's what we like to go through here. So how people will use it as a line of credit to wrap this up is they know that this money is forever compounding here, keeps on going up, which is good. Get the snowball effect. And then when opportunities come around, I know I can access my cash value while it continues to compound and take advantage of other opportunities that also compound for me. Hopefully I'm earning a return there. So I hope that this made sense. If it did, please let us know. Feel free to leave a comment below, hit the like button, and as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.